The impact of crypto's issues last year continued to reverberate right through the sector. More bankruptcies, more fallout, especially from FTX. As we try to chart a path forwards, figuring out what went wrong remains crucial. But as we reflect, one question keeps coming up. Are these really crypto problems, or are they CeFi ones? Regulation is coming for crypto this year. If you don't believe us, just take a look at some of our recent episodes on why and where that is. But the focus of so many lawmakers has really been on what happened with FTX, and what's been happening with DeFi seems to be overlooked.
I think DeFi worked extremely well. It didn't break. Nobody lost any money, which obviously stark contrast to what happened in the centralized model.
That's Rob Alcorn, who is CEO of Clearpool, a company which calls itself the first decentralized marketplace for uncollateralized lending. A bit of a mouthful, admittedly. But essentially, it's a peer-to-peer or a DeFi marketplace for loans. Now, Clearpool's token CPool is used to determine interest rates for lending and borrowing. That mechanism is supposed to help raise and lower interest rates on loans and incentivize a stable marketplace. It claims that this was successful right through all of the uncertainty last year, and it's an area some people are talking about as a potential driver for crypto growth in 2023. Centralized exchanges like FTX seem to be focused on proving reserves and worrying about all of the looming regulatory changes. In DeFi, when it comes to lending at least, things sound a little bit different.
The way it works when you have this centralized model is that risk is allowed to build up in the system, and usually it's too late by the time you realize that you have this systemic risk. Whereas in DeFi, it's a lot more transparent.
Clearpool reckon that the current market uncertainty is going to be the key to driving growth for protocols like their own, and others are also taking big action in this space as well. The crypto arm of Japanese banking giant Nomura has just invested in this area. Earlier this month, Laser Digital said it was putting money into Infinity, which is another DeFi finance protocol. Bloomberg's Subhashri Ghosh said that the move, quote, shows continued interest among financial institutions in crypto even after the collapse of FTX. And this has big potential. Head of Ventures at Laser Digital, Olivier Dang, said Infinity's groundwork paves the way for institutional flows on-chain, new levels of rates and risk innovation. At a time when the mood across crypto has soured, the idea of something unlocking anything new and encouraging investment is going to be something that's welcomed. And it's this sort of promise that was emphasized to the Daily Forkast by Jocelyn Chang from MakerDAO.
There will be an increase of total value lock for DeFi for sure. And also the thing is, it just doesn't come from the spillover effect of, CeFi collapse, right?
Data from DeFi Llama shows that total value locked, or TVL, fell something like 75% in 2022. So far this year, it's up almost 30% to 50 billion. We are, however, still a long way off the giddy highs of 2021 when TVL peaked at around 180 billion. Some say that's proof that DeFi is going to continue to struggle. Initiatives like finance protocols could be set for months of stagnation. Most of DeFi's value also remains locked up in around 15 or so core projects. And that's one reason why things look tough for smaller, newer ventures.
The industry has to mature a little bit. It's still very young, and we need more of a focus on risk management and giving the lenders the ability to manage and hedge risk effectively. Is something that Clearpool has been focused on since the very beginning.
There are other big challenges facing the whole of crypto, of course. Macroeconomic conditions remain hugely uncertain. Threats, of course, from both recession and stubbornly high inflation still. And with the looming uncertainty of regulation we've already mentioned, there are big reasons to worry. But optimism in DeFi for finance protocols and others remains.
Users are more educated these days as compared to maybe, say, 4 or 5 years ago because of what happened, in the past 6 months. So it's not something bad, but I guess, sometimes when things happen like this, we kind of flushed out the bad players, right?
it's just kind of an education process to try to help people understand why this technology can be used for the better. And I think this year we will see more institutions and more people start to get more comfortable using these decentralized mechanisms.
All right, that's it from us. If you like this video, please subscribe to our content to see other things like it, and let us know your thoughts on what's happening in DeFi, in lending or elsewhere, down below in the comments or wherever you're watching this video.